For many years we called it the everything bubble, possibly the biggest economic bubble the world has ever seen, encompassing almost every aspect of the global financial system, but most specifically stocks. Over the course of the past decade, central banks have pumped tens of trillions of fiat dollars into the system to keep it on life support, but now it seems the party is over. The pervasiveness of corporate stock buybacks and driving equities to record highs cannot be overstated. And without easy money provided by the Federal Reserve through near zero interest overnight loans, such stock buyback bonanzas would not have been possible. The misuse and abuse of the buyback strategy allowed many corporations to present a false face of profits and success. But eventually the real-world consequences of inflation and economic decline touched ground, which is where we find ourselves today. At this time, the Dow Jones has lost around 17% of its value since it hit all-time highs in January of this year. The Nasdaq has lost around 24% in the last year, and tech stocks, once the darlings of retail investors, are crumbling. Though equities received a boost from COVID stimulus measures in 2020 and 2021, which injected over $6 trillion into the U.S. economy in a single year, this boost was short-lived and remains dependent on one thing: near-zero interest rates from the Fed. As we saw over the course of 2018, the last time the Fed hiked rates, it does not take much to pull the rug out from under markets. The mere threat of a larger-than-normal rate hike caused an expanding decline in markets. The Fed's actual announcement of a 75 basis point rate hike, the largest in 28 years, has sent shockwaves through stocks at a time when many investors were hoping for immediate capitulation from Chairman Jerome Powell. The stock decline of 2018 triggered a reversal from the Fed. Why wouldn't it work again this time? Of course, the difference this time is that inflation rates are hitting 40-year highs and the Fed has a perfect excuse to continue tightening. A 75 basis point rate hike will do nothing to stop inflation, but the central bankers can at least claim they tried. The bottom line is that there is nowhere for the Fed to go. Either they do nothing to answer the rising inflation threat and are viewed as culprits behind the crisis, or they hike rates and crash stocks. Those are the two choices, and anyone that tells you there is a third option or soft landing scenario is lying to you. Central banks and governments will now put a lot more energy into presenting scapegoats for stock declines than they will put into trying to save markets. The narrative shift has already been in full swing, with the blame going to the pandemic or the Russian invasion of Ukraine. Some leftists, like Larry Summers, are even trying to blame conservatives for the crash because they supposedly undermine the legitimacy of the establishment system. But none of these scapegoats will stick. Polls show that the majority of Americans now blame Joe Biden for economic instability as well as inflation and prices. This sentiment has translated to a steady decline in Biden's public approval rating, which has sunk to 39%. Though Biden's handling of the economic situation is dismal and his consistent lies about the reality of the crisis are driving down his popularity, it is unfortunate that the public is less aware of the role the Federal Reserve has played in the overall crash. It is really the Fed, with the help of numerous presidents, that has created the mess we are seeing in 2022. The move to kick the can down the road on the credit collapse of 2008 has led to inevitable inflation in prices coupled with deflation in GDP, retail, stocks, and weakness in wages. In other words, the result is stagflation. The last time we saw stagflation of this magnitude in the late 1970s to early 1980s, the Fed had to raise the effective funds rate to nearly 20% to pop the bubble. And this was at a time when the US dollar was being vastly globalized as the world reserve currency. Now, the reverse is taking place, with the dollar's world reserve status in decline and many trillions of dollars in stimulus in circulation that can flood back to the US economy at any point. It is hard to say exactly how far the Fed will hike rates under the current conditions, but it is easy to predict the outcome of any continued hikes. The days of the buy the dip strategy are coming to an end, and sell the rip will become the new mantra for a new generation of investors. In the meantime, one can only hope that the public will soon become aware of the critical role central bankers have played in the crisis that we now face and act accordingly to remove them from power.